What if the crash of 2025 wasn't a market event, but a system failure? In October 2025, Bitcoin faced one of its most volatile weeks in history. Within just a few days, prices tumbled from over $126,000 to just under $105,000, triggering a $19 billion liquidation in the crypto market. Major exchanges paused trading temporarily. Stablecoins mostly held their peg. Tens of billions of dollars were liquidated, and the crypto market fell into chaos. The media called it Crypto Volatility 2025. But let's imagine for a moment, what if it hadn't stopped there? What if Bitcoin kept falling, to levels nobody thought possible? What if this wasn't just a correction, but the true end of the speculative crypto era? What would that world look like? It starts the same way every panic does, liquidation. After a massive wave of margin calls, Bitcoin breaks below 10,000, then 5,000. Institutional investors, once seen as the backbone of crypto's legitimacy, begin to pull out. Bitcoin ETFs, which were meant to bridge Wall Street and crypto, record historic outflows. BlackRock, Fidelity, and other major funds quietly freeze new inflows, citing systemic instability. Confidence, the most important currency in the crypto world, begins to vanish. In just a week, over $200 billion are wiped out of the total market capitalization. Altcoins, which rely on Bitcoin's momentum, collapse even faster. Ethereum drops below $500, Solana returns to single digits, and entire ecosystems built on borrowed liquidity start to vanish. Then, the miners start to bleed. For the first time in years, the cost of mining Bitcoin exceeds its market price. Electricity bills pile up, and mining farms from Texas to Kazakhstan begin shutting down. Some try to relocate to regions with cheaper power, but energy prices surge globally, and governments tighten regulation on large-scale mining operations. The global hash rate, a measure of the network's total computing power, drops by nearly 60%. As it falls, the network slows. Transaction fees skyrocket to over $100 per transaction, making it nearly unusable for small transfers. And for the first time ever, Bitcoin, the symbol of unstoppable decentralization, starts to look fragile. A weaker network also means weaker security. Smaller mining pools shut down, raising fears of a 51% attack, where a single entity could control the majority of the blockchain. Even if it never happens, the fear alone triggers chaos. Some exchanges suspend withdrawals out of fear that the chain could be compromised. Bitcoin's mempool grows uncontrollably as unconfirmed transactions pile up for days. Critics who once called Bitcoin digital gold now compare it to a collapsing Ponzi experiment. Then comes the stablecoin crisis. Tether, USDT, and USDC, supposedly stable, begin to depeg as investors rush to redeem for real dollars. Rumors spread that one of them no longer holds full reserves, and that some of its collateral was held in illiquid real estate and corporate bonds. A single tweet sparks a digital bank run. USDT briefly falls to 85 cents before recovering, but the damage is done. If stablecoins aren't stable, nothing in crypto feels safe anymore. Exchanges face liquidity shortages, some halting withdrawals for up to 48 hours. The psychological damage to investors is irreversible. Governments step in. The U.S. Treasury, SEC, and Federal Reserve hold an emergency joint session. Their response: regulate fast. Withdrawals from centralized exchanges are delayed for security checks. The European Union fully enforces its MiCA framework, freezing non-compliant stablecoins from trading. China reintroduces its total crypto ban, this time powered by AI-driven blockchain surveillance that can detect and block transactions in real time. Japan and South Korea follow with strict capital control laws, forcing exchanges to register under new financial watchdog programs. The dream of decentralized freedom turns into a global crackdown. And the damage spreads beyond crypto itself. The collapse hits the real economy. Fintech startups, mining companies, and chip manufacturers dependent on crypto demand, all start to fail. Stock prices of Nvidia, AMD, and major energy suppliers fall sharply. Cloud service providers report major losses as blockchain projects shut down servers en masse. Countries like El Salvador, which hold large Bitcoin reserves, face national debt crises. Their credit ratings fall, tourism collapses, and the IMF steps in with emergency loans. Banks tied to crypto liquidity face runs, creating potential contagion across traditional finance. Ordinary investors, especially in developing countries, suffer the most. Millions lose their life savings. Entire communities built around crypto-based remittances and savings programs disappear. NFT marketplaces turn into ghost towns. DeFi projects vanish overnight as smart contracts are drained or abandoned. The blockchain job market collapses, and most Web3 startups, once valued in the billions, dissolve. Silicon Valley venture funds write off massive losses, calling it the biggest tech wipeout since 2000. But as with every collapse, some sectors benefit. Central bank digital currencies, CBDCs, gain traction as the safer alternative. Governments see this as a chance to rebuild financial systems under tighter control. Blockchain technology doesn't die, it simply shifts direction, moving towards supply chain verification, digital identity, and government data systems. Big tech companies like Google, Amazon, and Microsoft acquire struggling blockchain firms and integrate them into their ecosystems. Decentralization quietly gives way to corporate consolidation. Within a year, 90% of blockchain computing power is managed by fewer than 20 major data centers. Socially and economically, this would be crypto's 2008 moment, a full-scale reset of the digital economy. Investors would finally face the true cost of speculation and leverage. Academic institutions start teaching digital economy risk management as part of mainstream finance degrees. Governments begin mandating transparency laws for digital assets. The myth of anonymous wealth fades as every major blockchain address becomes linked to verified identity through global regulatory cooperation. In the long term, such a collapse could make the technology stronger, less hype-driven, more grounded in real-world use. So, would Bitcoin survive? Probably yes, but not in the same form. Bitcoin isn't a company. It has no CEO, no headquarters, no board. It exists as long as people keep running the network. But its meaning would change forever. It would evolve, from a symbol of financial freedom into a global lesson about the limits of digital belief. Because the collapse of Bitcoin wouldn't necessarily mark its death. It could mark its transformation, from a speculative asset into a foundation for something more stable, more integrated, and perhaps less idealistic. Bitcoin might no longer stand for getting rich. It might stand for a harder truth, that every system, no matter how decentralized, still depends on trust. And that's the real experiment. Not about price. Not about hype. But about whether belief itself can survive the crash. Because belief is what built Bitcoin, and belief is what could destroy it. If October 2025 was just the beginning, then maybe this was never about money at all. Maybe it was about how far humanity can go before it realizes that even in the digital world, faith still has limits.